Job opportunities in finance, information technology, and IT-enabled services sector. Are you willing to work in front, middle, back office in financial markets? Or, are you willing to switch your career in IT and IT-enabled services sector as quality analyst or consultant? Want to switch your career from manual testing to business analyst role in IT? Or, want to switch your career from technical to techno-functional role in IT? We provide job consultation, interview preparation, and training services for all of the above job opportunities by industry professionals. No prior knowledge of finance is required. Who is eligible? 1. Any graduate, B. BTech, BSc, BCom, BBA, BCA, BA, fresher or experienced. 2. Any postgraduate, MBA, MCA, MTech, CA, fresher or experienced. Connect us on finpro.trainings@gmail.com or +91 8788 122 096. WhatsApp only. The basics of bond markets. The basics of bond markets. We will discuss about 1. What are bonds? 2. Bond transactions. 3. Bond features like yield, maturity, YTM, coupon, etc. 4. Bond types like zero coupon, fixed/floating rate, asset-backed, convertible bonds, etc. What are bonds? Bond is a debt investment, in which an investor loans money to an entity, a corporate or government, that borrows the funds for a defined period of time, at a fixed or variable interest rate. When you purchase a bond, you are lending money to government, municipality, corporate, or any other agency, issuing the bonds. In return for the loan, the issuer promises to pay a specified amount of interest during the life of the bond, and to repay the face value or principal of the bond at maturity or due date. For example, if you buy a fixed coupon bond with face value of $1,000 and a coupon rate of 8% with semi-annual interest payment, the investor will receive a 6-monthly coupon of $40, that is $1,000 multiplied by 8% divided by 2, till the life of the bond, and will receive principal payment $1,000 at maturity, along with the last period interest. Bond transactions. Bond issuers like central governments, state governments or private corporations are issuing the bonds through bond dealers. Investors like households, funds like mutual funds, hedge funds, sovereign funds, etc. Institutions like private or commercial banks are buying the bonds through bond dealers. At initiation, securities, that is bonds, flows from issuer to investors, and money flows from investor to issuers via bond dealers. Coupon or interest payments, in case of coupon-paying bonds, are processed through paying agents at predefined intervals, like annual or semi-annual. Bonds are traded in secondary market once issued. Investor can enter or exit from bond using secondary market prior to its maturity. Features of bond. Below are the features of the bond, which we will discuss in this session. Par value or initial value, coupon rate, bond maturity, issue price, market or current price, bond yield, yield to maturity, that is YTM, and indenture. Initial or par or face value of bond. Par or face value is the amount of principal the issuer must pay back to the bondholder. Par or face value is used with bond's price to determine the market value of bond. It is used with the coupon to determine annual income payments. Many bonds have a par value of $1,000. However, bond prices are normally quoted as the price per $100 of face value. In below example, bond is having face value of $1,000, with tenure of 1 year, and coupon rate is 5%. So at the end of tenure, bondholder will receive $1,050 including principal that is $1,000, plus interest that is $50. Coupon rate. This is the interest rate that issuer pays to the bond holders. Usually this rate is fixed throughout the life of a fixed coupon bond. It can also vary with a money market rate such as LIBOR, or SOFR, or MIBOR, in case floating coupon bonds. Coupons can be paid at different frequencies, such as monthly, quarterly, semi-annual, or annual. For example, bond having par value $1,000, maturity of 4 years, and coupon rate 7%. The annual amount of interest paid by the bond, calculated as 7% of $1,000, that is $70. In above example, bondholder will receive an interest or coupon of $70 at the end of year 1, year 2, and year 3. On maturity, investor will receive $1,000 principal plus $70 coupon, total equals to $1,070. Bond maturity. Maturity date is the date on which the issuer has to repay the nominal amount, or principal, to the bondholder. The length of time until the maturity date is often referred to as the term, or tenor, or maturity of a bond. Depending upon bond maturity, bonds are termed as short-term, 1 to 4 years, medium-term, 5 to 10 years, and long-term bonds, 10 to 30 years. The volatility of the bond's price is related to its maturity. In below example, you can see the long-term bond, issued on January 1, 2020, having 10 years of tenor, and maturing at January 1, 2031. Issue price. The price at which investors buy the bonds, when they are first issued, which will typically be approximately equal to the nominal amount. The net proceeds that the issuer receives are thus the issue price, less the issuance fees. In some cases, like zero-coupon bonds, issued at discount price, and it will give principal plus interest at the end of maturity. In the following example, a zero-coupon bond having face value of $1,000 and maturity 1 year, issued at $955. In this case, issue price is discounted, and the discount amount is nothing but the interest paid by the bond, that is $45. Market or current price of the bond. The market price of a bond is determined using the current interest rate compared to the interest rate, or coupon rate, stated on the bond. The market price of the bond comprises of 2 parts. The first part is the present value of the bond's face value, and second part is the present value of the bond's interest payments. In the following example, a bond is issued at face value $1,000 on 1st of January 2021, and having 1 year maturity. If we want to calculate the current market price of the bond, on June 30, 2021, that is 6 months after issue date, we need to consider the present value of the principal amount $1,000 and present value of the coupon payment $100. In this case, as current interest rate 10% is same as coupon rate 10%, the bond's price will be approximately equals to $1,050, as half tenure is remained. We will see how the price of bond is calculated in bond pricing section in detail. Bond yield. The effective rate of interest paid on a bond, calculated by the coupon rate, divided by the bond's market price. This is also called as real interest rate, investors will get on holding of bond until maturity. Current yield equals to annual dollar interest paid divided by market price into 100%. For example, if investor purchased a bond with a par value of $1,000 for $959 and it paid a coupon rate of 5%, we can calculate current yield equals 50, coupon amount, divided by 959, current market price, multiplied by 100%, which comes to 5.2%. We will see how the price of bond is calculated in bond pricing section in detail. Yield to maturity, YTM. YTM is that interest rate by which the present values of all future cash flows of the bond are equal to the bond's price. An easy way to think of YTM is to consider it the resulting interest rate the investor receives if he has invested all cash flows, that is coupon payments, at a constant interest rate until the bond matures. It takes into account the time value for money. Yield to maturity is calculated by formula below, also by approximation or trial and error method. YTM is equal to annual interest plus into bracket par value minus market price divided by number of years to maturity, bracket complete, divided by par value plus market price divided by 2. Calculate bonds YTM if coupon rate 8%, face or par value $2,000, current market price $1,800, maturity equals 4 years. YTM using above formula equals 11.05%. In above example, it indicates that YTM is greater than coupon. That means bond is trading at discount, and hence offers more return than coupon rate. YTM is essentially a bond's internal rate of return, IRR, if held to maturity. YTM can be used as a metric to decide if a bond is a good investment or not. It helps to decide if a bond is worth investing or not. You can compare the YTM of a bond with other bonds to see which one has a better road to maturity. YTM can also be used to compare bonds with different maturities for a like-to-like comparison. The important point to know is that YTM gives you expected returns.
Indenture. Indenture is an agreement between the issuer and the bondholder. The provisions of an indenture are called covenants. An indenture will likely include the following clauses. Purpose: the agreement states the reason why the bonds are being issued. Interest rate: this is the interest rate stated on the face of the bond, also called as coupon rate. Interest calculation: this is a description of the formula used to calculate the amount of interest to be paid. We will discuss these formulas in detail afterwards. Payment dates: the dates when interest payments will be made to the bondholders. Maturity date: the maturity date of the bond, when the face amount of the bond will be paid to the bondholders. Call features: this explains the rights of the issuer to buy back bonds prior to the maturity date. Conversion features: this is an explanation of the circumstances under which bonds can be converted into the common stock of the issuer, and at what conversion multiple. Covenants: this is a list of the covenants to which the issuer will be subjected while the bonds are outstanding, and how the covenants are calculated. Non-payment actions: this can include a number of possible actions, such as increasing the interest rate, creating a cumulative interest liability, or accelerating the maturity date of the bond. Fixed-rate bond. A fixed-rate bond have a coupon, which remains constant throughout the life of the bond. In below example of fixed-rate coupon bond, with face value of $1,000, coupon rate of 5% payable annually, and maturity 4 years. The bondholder will receive interest of $50, that is 1,000 multiplied by 5%, at the end of year 1, 2, and year 3. At maturity, investor will receive principal payment of $1,000, along with the $50 interest for year 4. Floating rate bond. The floating rate bonds pay coupon interest rate, which are set by a coupon formula, based on some reference interest rate, such as LIBOR, London Interbank Offer Rate, or SOFR, Secured Interbank Overnight Interest Rate, which is Federal Reserve USA's reference rate, established as an alternative to LIBOR. On each reset date, the new coupon rate is determined as coupon rate equals reference rate plus quoted margin. Typically, the reset date is 6 months prior to the payment of the interest. Floating rate bond example. Suppose, floating rate note, with a par value of $500,000, pay interest on June 30th and December 31st of every year, until maturity. The coupon rate is 6-month LIBOR, plus 1.25%, quoted margin. If the 6-month LIBOR is 3.45%, on June 30th, the interest that would be paid on these notes, on the following December 31st, would be $11,750. We can calculate the interest using below formula. Coupon interest is equals to 3.45%, plus 1.25%, divided by 2, as it's semi-annual, multiplied by $500,000, which comes to $11,750. Zero coupon bond. A zero coupon bond is a debt security instrument which does not pay interest. Zero coupon bond trades at deep discounts, offering full face value at maturity, that is principal plus interest. The difference between the purchase price of a zero coupon bond and the face value indicates the investor's return. In the below example, a zero coupon bond having face value $1,000, issued at $925, having maturity of 2 years. Investor return on this zero coupon bond can be calculated as difference between face value and the issue price, that comes to $1,000 minus $925, that is, $75 for 2 years. In percentage term, investors' annual return would be 3.98%. Let's see how the zero coupon bond yield is calculated. For a zero coupon bond, which has only one coupon payment, and hence issued at discount, the yield calculation is given by below formula. Yield is equals to future value divided by purchase price raised to 1 upon n minus 1, where n is years left until maturity. Consider a zero coupon bond that has a future value of $1,000 and matures in 2 years and can be currently purchased for $925. This is how we would calculate its current yield, which is equals to 3.98%. Optionality of bonds. Callable bond is a bond that can be redeemed by the issuer prior to its maturity. Usually, a premium is paid to the bondholder when the bond is callable. There are 3 broad categories of callable bonds. European callable can only be called on a certain date. For example, if bond maturity date is 30th of December 2025, till this date, few dates mentioned in call feature, on which bond can be called back. Bermudan callable can be called until a certain date. For example, if bond maturity date is 30th of December 2025, issuer is allowed to call the bond until January 1, 2022, but after that he can't. American callable can only be called after a certain date. For example, if bond maturity date is 30th of December 2025, issuer is allowed to call the bond on any date from January 1, 2023 onwards until maturity. Bonds can also carry put options, which allow the investor to sell the bonds back to the issuer at a date specified. When the bonds are sold to the investor are called puttable bonds. Inflation-linked bonds tips. Inflation-linked bonds, in which the principal amount and the interest payments are indexed to inflation, to protect investors from the decline in the purchasing power of their money. The interest rate on these bonds is normally lower than for fixed-rate bonds with a comparable maturity. However, as the principal amount grows, the payments increase with inflation. Below is a comparison of the 10-year tips as compared to the 10-year Treasury note. On March 29, 2019, the 10-year tips was auctioned with an interest rate of 0.875%. On the other hand, the 10-year Treasury note was auctioned March 15, 2019, with an interest rate of 2.625% per year. We can see that the 10-year note pays more interest, meaning that investors will receive higher coupon payments from the 10-year note as compared to the TIPS investment. However, if inflation rises, the principal on the TIPS will increase, allowing for the coupon payments to rise, while the 10-year note is fixed for the life of the bond. Although TIPS protect against inflation, the offset is typically a lower yield than bonds with similar maturities.
Convertible bonds. As the name implies, a convertible bond gives the holder the option to convert, or exchange it, for a predetermined number of shares in the issuing company. When issued, they act just like regular corporate bonds, albeit with a slightly lower interest rate. Because convertibles can be changed into stock, and thus benefit from a rise in the price of the underlying stock, companies offer lower yields on convertibles. If the stock performs poorly, there is no conversion, and an investor is stuck with the bond's subpar return, what a non-convertible corporate bond would get. As always, there is a trade-off between risk and return. Companies issue convertible bonds or debentures to lower the coupon rate on debt. This enables the issuer to save on interest expenses, which can be substantial in the case of a large bond issue. The chart shows the performance of a convertible bond as the stock price rises. Notice the price of the bond begins to rise as the stock price approaches the conversion price. At this point, your convertible performs similarly to a stock option. As the stock price moves up, or becomes extremely volatile, so does your bond. The exception occurs when the share price goes down substantially. In this case, at the time of the bond's maturity, bondholders would receive no less than the par value. Asset-backed bonds. Asset-backed bonds are securities whose interest and principal payments are backed by underlying cash flows from other assets. Examples of asset-backed securities. Mortgage-backed securities, MBS. A mortgage-backed security is an investment, similar to a bond that is made up of a bundle of home loans, bought from the banks that issued them. Investors in MBS receive periodic payments similar to bond coupon payments. Collateralized mortgage obligations, CMO. A collateralized mortgage obligation refers to a type of mortgage-backed security that contains a pool of mortgages bundled together and sold as an investment. Organized by maturity and level of risk, CMOs receive cash flows as borrowers repay the mortgages that act as collateral on these securities. In turn, CMOs distribute principal and interest payments to their investors based on predetermined rules and agreements. Collateralized debt obligations CDO. A collateralized debt obligation, CDO, is a complex structured finance product that is backed by a pool of loans and other assets, and sold to institutional investors. A CDO is a particular type of derivative because, as its name implies, its value is derived from another underlying asset. These assets become the collateral if the loan defaults.